Just recently, we had the second anniversary of Russia's invasion of Ukraine. That's a sad reminder that geopolitical risks can materialize and that geopolitical risks have economic, inflationary, and implications on corporate profits. Although financial markets do not care about it at the moment, looking forward, in respect to the energy transition, but also in respect to many other areas of raw materials and the global architecture of security setups, this war in Ukraine will matter. And we will also see that other geopolitical risks have an impact on the economic performance over coming years. In that respect, it plays a role in our 5-year projections. There, we expect that going forward, we will have a heightened environment of geopolitical risks with military action going on. At the same time, we do not expect in the base case there will be huge escalations. But this will remain a substantial risk. Looking forward, over time, it will matter how governments and companies deal with the pressure coming up from the 4 Ds. That's digitalization, deglobalization, demographic change, and decarbonization. In respect of their way to deal with this, we will see how the economy and the inflation outlook will play out. Overall, we think that in combination, those 4 factors will dampen growth and increase inflationary pressure. And in that respect, these developments will have an impact on the upcoming easing of monetary policy. Because of this underlying inflationary pressure, the reductions in interest rates, which are likely to start by the mid of this year, triggered by the Fed, will be only limited. And in that respect, the markets will not likely to go through the roof, but we will only see a moderate improvement. Looking at what are markets pricing in at the moment, we think that the expectations for the Fed up to the end of this year, having reductions about 75, 80 basis points in interest rates cuts, that's appropriate. At the same time, expectations for ECB rate cuts of about 90 basis points still seem to be overblown. Nevertheless, looking at the fixed income markets in total, we think that we have seen the peak in government bond yields and expect somewhat lower yields in 12-month time. So this correction on the fixed income markets have taken place. But this is not the case on equity markets. Here we have seen euphoria regarding AI in recent weeks that has corrected everything what was going on the fixed income market side. On top of this, we still have the expectations that there will be a no landing in the US. And although we are optimistic for the US economy, we think that there will be a slowdown coming. And taking this into account, we expect that there will be a correction in equity markets coming up in the coming month. But nevertheless, we remain optimistic for the outlook in coming years and expect that the DAX will be higher than 20,000 from 2026 onwards.